All right. What's up, everybody? Ian Walsh, your Hard Money Bankers, joined my partner Ryan Walsh from Hard Money Bankers. And our guest of the 15-minute segment is Joseph McCabe. Joe, how you doing?
What's up, guys?
Not much. Yeah, thanks for being on. We've actually been doing this since the market started shifting. We've been reaching out to really high producing realtors and brokers and investors, and just having them on the show and just to get their perspective on like what's going on in the market right now, what they're seeing. I was just talking to Ryan about some of the international stuff right before you hopped on. So what have you been seeing from your perspective on like the market shift and the interest rates rising and all that kind of stuff?
Yeah. So kind of like you guys are, we're in real estate, mortgage, and title. And title's nationwide, mortgages nationwide. Title's all 50 states, mortgages are maybe about 10. But we're seeing the same, I think this time last year, rates were 3.1, 3.2 for just your 30-year fixed. Now we're upwards of 5.3. So you're seeing, obviously, all the businesses that were doing refi, they're crushed. The purchase applications are down significantly because people can't qualify for as much. And, there's basically no inventory. I think inventory-wise, year over year, I think we're down about 6.1% for home sales.
I mean, it's like the exact opposite of what they said last year, right?
Right. It's crazy. I mean, last year actually, even last year, they were like, wow, inventory is really tough. But it really wasn't. It really was. It was more that inventory was tough because it was flying off the market. Mm-hmm. Now inventory is tough because there is no inventory. So it's a little different, I guess. And that's all coming back to the rates.
Yeah, the rates, I think, ultimately, because it just knocks buyers out of the purchase. Like, so if you could, I mean, everybody started to see those online posts where people are like, okay, like at 3%, a $350,000 house is $1,400 a month. And then at, the new 5.3% or whatever, a $350,000 house costs you $1,900 a month. And when that happens, I mean, that's a buyer that locks in 6 or 8 weeks ago and goes, oh, it looks good. And then they go, wait a minute, my payment's $500 more a month. That's a 20% bump. I can't do this. So it just knocks out a whole lot of buyers. And you mentioned, so you're in 10 states with title right now or no?
With mortgage, we're in 10. With title, we're in all 50.
Okay. Which business does title do more transactions in general?
Yeah. So we're mainly purchase transaction to begin with. We mainly do joint ventures with real estate brokers. Okay. We had a joint venture with a mortgage company that was all refi, and that pretty much entirely died in October.
Okay.
As things started.
Wow.
Yeah. Because, with the people that, a lot of the consumers, I mean, these people will refi for like a tenth of a point. It's ridiculous. So, if it goes up at all, their business dies. And a lot of times with that company, we would churn the same person 3-4 times a year. We would get title insurance for them. Maybe it was insane. But that's how much the rate meant to them.
So the refi world, the commercial refi world took a big hit in terms of October. What are you seeing right now? Like right now, what are the other title companies like? What are they experiencing?
We're seeing, so we're in a good business because when I'm recruiting loan officers for the mortgage company, we're always up against the loan officers that work in call centers. And I always tell them, it's like you have no value to the marketplace. The realtors, the loan officers, the people who survive a market turn, and I think we're going to have a big, ugly market turn. It's pretty alarming what's happening. The ones who actually make it through are the people who were in the purchase business, because purchases are going to happen all the time, regardless of the rates. People will need to buy. They'll have to relocate. Investors are always going to keep moving. They'll just pivot, and but the prices will adjust accordingly. Whereas if you're in the refi, I mean, you're not building relationships with anybody. People are only coming to you because you're the cheapest. So we try to explain that to them. And, one big thing we're pushing with our realtors now is you should know this stuff because you want to be able to educate your clients. And it's important to say, like, since these are the highest rates we've had, I guess, since 2009 is pretty much where we are now. And it's important to be able to educate your clients on that. But as long as you're disciplined in the day-to-day stuff that you're doing to generate business, you'll pull through. I mean, the top agents always pull through. Most of them don't even see a dip in volume. They just pivot and they start working with investors. And, I know for me, I'm conserving as much cash as possible because I'm waiting for the bloodbath. It's going to be time to pick up properties, get some nice multifamily residential stuff. And, that's where the winning is. You win on the bottom.
Yeah, we were just talking about Ryan and I were talking about there's like a lag right now. There's this like momentum that came off COVID and a momentum that came off the historically low rates where like people are just in a frenzy, right? So there's like just sharks in the water. They're still frenzying, but they're not. I don't think anybody realized. Like it's almost like when you see that shark frenzy and there's just like a cloud of fish getting eaten, but there's a cloud, so you can't see anything. But all the sharks are in there trying to grab something. And I think as like the dust settles and you're like, oh, there's only like one fish there anymore. And so everybody right now has that momentum of being a shark in like blinded waters, and they're still out there. So they're still out there. Everybody's like, oh, I had 30 offers. I had 40 offers on this house. And I'm like, there's just this weird momentum from COVID and low history rates that are out there. So everybody's there's a frenzy, but that's going to fade once like the cloud clears and people go, oh, it's 6%, 7%. I mean, we have like 2-3 more rate hikes coming this year. People are just going to like calm themselves down and be like, I can't buy anymore in this rate. So then where are we? Right. So then like, where's the bottom of that? Because we just ran the numbers that 2% hike from where we were, a 2-point hike really is like 20% in buying power. Well, is that 20% in purchase price? Does that mean if you had a house at 500,000, you're down to 400,000? Like, what's your take on that in terms of where you kind of settle in on a bottom?
Yeah, I don't know. There's an interesting, I'll say this, what I'm seeing we're seeing a lot more interest in ARMs on our mortgage side, and we're actually seeing people already start to close with them. So I would say our nationwide apps are up. I think they're the highest since 2008, the application on ARMs.
For adjustable rates? Why?
Yeah.
Why is that?
It's just because they're slightly lower than a standard fixed 30-year rate.
Wow, that's a desperation.
And people don't understand, just like 2008, people don't actually understand what an ARM is. They don't understand that the rate could be higher when they have to get out of this loan. And who knows? I mean, rates should have, honestly, 5 to 7% is where rates should probably be anyway,
Yeah.
But I think where it's going to bottom out, and I think this is the part that no one can really forecast, although it's interesting, every asset class is inflated at this point. It's not just mortgage-backed securities. It's not just real estate. It's the stock market. It's crypto. There's so many things happening at once. It's just like they keep trucking on regardless of the fact that, the world is in kind of complete chaos or should be. But all these assets just keep climbing. So how low can it go? I don't know, but I feel like it has to be pretty bad.
I think so too. I just don't see, and it's always, I always say about markets that I've always noticed, whether it's, in trading or in real estate, that it just always goes further than people expected. So like it went higher than people thought it could possibly go. So like the bears aren't really, and then the bears come in and the bulls go, oh, there's no way it could go more than like 15%. And then you're down 40%. You're like, you're screaming uncle, right? So it's always going to find that uncle point. And I don't know where it is. I think as soon as you start to dip, you start going, first people go, okay, it can't go more than 20%. And that's like, they blow right through that. And then you start going, okay, well, a traditional correction is 35%. So people are like, can't go more than that. And then you blow right through that door, and COVID was like a shot across the bow with that, because that just flew off. I think it was a 35 or 40% drop, but it rebounded so fast that by the time everybody stopped and turned around, it was already over. I don't think this is that scenario, because you actually have constriction of money in the economy. Like there's not going to be money to go around due to purchasing power. So I think you're going to see 2-3 years. People can't survive that. Like if you couldn't survive that 3 months in COVID, or you barely survived it, you're in trouble right now. I don't know if you know it. Yeah, not you, I say in general.
Yeah. No, I was reading somewhere that, the other interesting thing is just the general inflation with fuel and just regular consumer products.
Yeah.
I think 8 out of the 9 times historically that the Fed has made any attempt to solve inflation, they caused a recession. And that's what they're doing right now. So, chances are they're going to put us immediately into a recession.
Man, I love this show because we have such a range of people coming in and telling what they're seeing, what they're forecasting.
Yeah.
And you're all players too, right? You're all producers, and you all have valid viewpoints. But nobody has, there's not like when COVID struck, there was a very general message going out from everybody we had on the show. Like, you may have to pivot, but we're going to get through this. That is not the message going out right now. Some people are saying, there might be a small correction, but then you have other people such as yourself being like, we're preparing, right? Like we're getting ready for it. And if it doesn't happen, fine, but we're getting ready for, possible real movement here. So
I think one thing that scared me for a few years now is watching big institutional investors with a lot of money and, Harvard, MIT analysts buying multifamily storage. I think the only thing they didn't really touch until they're starting to touch it now is single family portfolios, but they're buying these things at like a 1% cash flow. It's insane. And they're okay with it.
Yeah.
2 to 3 cap rates and there's almost no cash flow. And it's like, well, you have, if you're that big but I think some of them are at such a critical mass, it doesn't even matter. A correction won't hurt them. They have so many units and law of averages.
Unless you're BlackRock, I don't really know. Like I know exactly the type of buyer you're talking about. I bumped into that quite a bit in the past few years too.
Yeah.
And what I've noticed with them is that on paper, their numbers work, but like the execution of being an investor, being like, okay, so you're telling me every project you're going to get, not you, but this type of investor, you're going to be at scale. Every project you have is not going to go over budget. Everything's going to be this much money. You're going to buy at the right comps because you don't even know how to comp. You're just sitting in front of a spreadsheet, So then like it kind of works while the market's saving you on the way up. Like you can get out of those things and you think you're smarter than you are kind of thing. And the moment you buy that, anybody right now that's bought in the last 6 months, 8 months, anything that is still in the project has to be thinking or will be thinking very shortly, like where are we going to sell? I mean, us as lenders, I look at this and go, all right, I think in the last 6 to 8 months, if we're looking at a 20% price drop just based on the interest points, that's any flipper's margin gone right out of the gates. That's gone. So where do we stand if it goes lower than that? So like, and we're extremely conservative for what we do. So anybody that was aggressive or didn't really know the market, like it's a rude awakening. And Ryan's prediction is September that like the eyes start opening up. I think people like on the inside of like you or somebody that's like very much in the business, you see transactions, you kind of like, you see things going on that the average person doesn't know. But I think like CNN and Fox News will really pick up on it in September. And I think that makes sense.
I've heard a lot about Q3 from different companies.
Oh yeah.
Okay. Just starting to conserve cash in preparation of that. Yeah, I could totally see that. I have about 100 properties in Pittsburgh, and I bought it about 2 years ago, all single family scatter site. I bought it about 2-3 years ago, and we actually just got an offer from a private equity firm for $3 million more than we bought it for. So almost double. We were into it for $3 million. They offered $6 million. And I was like, it's not my, but I was just telling everybody, I was like, this is bizarre. It's like they didn't even run the numbers because I ran the numbers and I would never buy this at that price. So crazy.
And that's recent. That's a recent offer.
Yeah. We close in 2 weeks.
Wow. And they're going to do it. That's great. I think, hopefully they're not watching the show.
Yeah.
But,
right.
Yeah. But I think that's part of the shark frenzy. I think that's part of like we're all in here and there's still a cloud around us and we don't even know. And I think liquidating right now in capacities like that, even if you were not at the top of a market, I still think that move for you probably makes sense. It's twice your price. It's just like, I gotta take it. I gotta move. Right. So, but that's, you're the first person that's come on now and been pretty direct about everybody's kind of been a little bit more like, I think things are going to be okay and stuff. I don't know if they're just saying that. I don't know if they believe that. Maybe they are. And
I know a lot of people are saying that, right? Because it's kind of weird I told my sales team last week, I was like, listen, it's going to correct. It has to. All the top people are saying it has to. Like we've seen this before. There's cycles. Yeah. But it is what it is, and you pivot, and actually out of the chaos will come opportunity, a lot of opportunity. And if you're properly prepared, and if you're doing all the things that for years I've been telling you to do as a salesperson, like build a database, build a book of business, you're not really going to get hurt. You're not even going to feel it because you're going to have such a huge pool of buyers that it doesn't matter. If you're a lender, you're going to have so many buyers, so many investors, it doesn't matter. Sure, the interest rate changes, the terms of the deals change, maybe the different areas change, but that's something too on the market. We haven't seen, we're starting to, but the foreclosures haven't really hit the market yet. I mean, what they did with these forbearances, which really wasn't a forbearance. It was like, hey, you can't pay your mortgage now, so we're going to give you 6 months of not paying it and then ask you to pay the whole 6 months at the end. Why would that have even been a good idea? Well, now they're going to start foreclosing on a lot of those people. So we haven't seen that yet either, which, even without the rates would have helped correct some of the prices. So just another factor. But I mean, with the right mindset, people will come out of this ahead of the game.
I think it's what you said. I think it's just like the fat needs to be trimmed. And then if you, like you said, if your sales agents or whether any of the industries, if they were in a position where they built correctly, like they're actually going to, you have an opportunity to flourish in that, because everybody else that had like 3 or 4 contacts that didn't do what they did, they're just going to go away. They're going to go back and get a different job, whatever it's going to be. Well, there's going to be 3 or 4 contacts that need to do business, and they're going to go to the people that are staying. So it's like a war of attrition, right? So like if you have a big book of business, you might feel it a little during the transition, but you're going to be like when that shifts and everybody, the fat gets cut, all of a sudden all those calls are going to come to you because you're just standing. You're the last guy standing. And I think we're going to see that. I mean, the richest people I know, or people that made fortunes, were at the bottom of the last turn, right? So they look like heroes now, but like they were just in the right place at the bottom of the last turn. And that, so just be there and then win the war of attrition, right? I think that's the message. And just like you said, rates might be a little different here, a little different there, but like if you know what you're doing in terms of, you have a substantial book, you'll just move your rates and you'll keep going. But if you were relying on those refis or whatever and you were just letting your book shrink, that's a different story, I think.
Yeah. Agreed.
I mean, it's all about having that strong foundation. If you have that strong foundation, you haven't been building just with sticks and duct tape on your business, you're gonna be great. Unless real estate literally stops happening, like transactions stop happening, somebody's got to take the business. And
everyone's gonna buy in the metaverse now.
Yeah, well, I mean, might need title companies there. So
right.
I mean, it's a very interesting time to be in the business, and it's great to hear from people that are, because you have such a broad view. If you're dealing with title, you're dealing with mortgage, you're dealing with investor yourself.
Multiple states,
like it's such a good perspective to have. We really appreciate you sharing, all the insight you have here.
Yeah, no problem. I'm glad you guys invited me on. It was awesome.
Yeah, this is good. And what we'll try to do, we're trying to follow up. Like we would like to do this every 6 months with people, because the market's going to shift. And I don't know if we're not going to try to bring people's videos up and be like, this is what you guessed. I'm not going to do that game. But it'll be interesting, because I don't know. Like I don't know where the hell we're going to be in 6 months. So I'm not going to.
You know what? Maybe I can lighten it up, because I said some pretty grim things about the market for the real estate people. When COVID hit in April of 2020, I actually started writing offers on all these businesses. I was like, there's so many of them that are petrified that are listing their businesses. I bet I can make a deal. Well, it could have been a laundromat. It could have been a Dunkin' Donuts. But this home healthcare agency reached out to me and said, we are petrified. None of our clients want us in the house. We're losing the business. Just take it. Well, we end up going from $1 million location to now $15 million in Pittsburgh, Scranton, and Lake Jackson, Texas, of all healthcare locations that we've acquired in the past 9 months.
Oh, wow.
So when people get scared, when people just overreact to the market, they don't stay consistent and disciplined, they're going to make mistakes. And if you're in the right place at the right time and you have capital, and we didn't even use capital, we used all seller financing, maybe like $200,000 of cash. But now we've got a $15 million home healthcare company. And my partner, who's also the chief growth officer for AmeriBest or AmeriHealth, I always mix them up. I think it's AmeriBest. He runs that on a day-to-day basis, and I'm just kind of a passive investor. So it sounds bad in the short term. In the long term, people are going to make a lot of money.
Moral of the story, just be ready for opportunity. I mean, that's what you're saying. I mean, that's good. That's where you should. I mean, that's the shit. Because there's no sense in sitting in the closet scared of everything. Like you might as well go out and be ready for opportunity. So, Joe, this is awesome, man. I'm glad we did this, and we'll do it again. And I think we're good to go. And we'll this will be right. Can you put Joe, or do you want people to contact you? Should we put your email on it?
Absolutely.
Okay. So, right, we'll put Joe's email in the email that we send out as well.
Yep, sounds good.
All right, cool. Appreciate it, Joe.
Awesome.
Thanks, man.
Thanks, guys.